Your credit score isn't just a number. It's a key that either unlocks a door to your dream home or locks you out for years. If you're thinking about buying a house, what you do with your credit now can either save you thousands of dollars in the future or it can cost you even more. So in this video, I'm going to tell you how to improve your credit score so you can buy that house without spending a fortune. You're going to learn, why does your credit score matter? How much your credit score affects your mortgage? The hidden cost of ignoring your credit, actionable steps to improve your credit score fast, and the timeline for what you need to be doing as you plan to buy a home in the next year. So let's get into it with, why does your credit score even matter when it comes to buying a home? And I think there's three things that you want to consider when you're thinking about your credit score and the impact they have on not only buying a home, but your purchasing power in general when it comes to things like student loans, credit cards, or anything. Focusing on buying a home, the first thing to consider is your interest rate. So that's one of the primary factors when determining what your interest rate will be when you're buying a home. This is going to help you determine the type of loan that you're looking at. Can you use a conventional loan? Can you use an FHA loan? Maybe there's a better fit for you there. And can you qualify for the type of product you want? This also can have a lot of impact on how much money you can borrow. Certain credit scores may limit you towards the types of loans that you can use, which will then limit how much money you have access to. So your credit has a lot more control than most people realize. Since credit score is a number, let's talk about those numbers and what they mean. So starting at the top, 740 and above is going to be your target. That means you'll qualify for the best programs available. This will allow you to use conventional financing, which can have better interest rates when you have a higher credit score, can also allow for lower mortgage insurance. Keep in mind, even a 0.5% difference in your interest rate could cost you $40,000 over the life of that loan. Now, I'm not saying you need a 780 credit score to buy a home. However, it can have its financial benefits. With that being said, there are great options available if you have, let's say lower credit scores. Based on your history, I'm not sure what led you there, but let's just say you're dealing with a credit score that's 600. In the lending industry, most lenders will go down as low as a 580. And I know what you're saying. I looked it up online and I saw FHA doesn't have a credit score requirement. I can get a VA loan and it doesn't matter what my credit score is. You got to keep in mind, FHA and VA, they don't lend money. Lenders do, and lenders are going to have that type of restriction on what they will lend and what their requirements are. So that usually starts at a 580. This is going to allow you to get an FHA loan. FHA loans can be a great benefit. With a lower credit score, you're going to see less of an impact on your interest rate. On the downside, FHA will have higher mortgage insurance. You also have an additional premium up front, which is called upfront mortgage insurance, which will eat into the equity of your home. FHA is great for certain situations, but the general theme here is that the higher the credit score, the more options you have. So then you could use FHA or conventional financing. Now, you may be thinking, well, if I can get a loan using an FHA with a 580 credit score, then why should I even be concerned with improving my credit score? And I've said this before and I'll continue to say it. Just because you can doesn't mean you should. Keep in mind, lower credit scores are going to impact that interest rate, the mortgage insurance, and those costs. This means you could be paying up to $400 more a month on your monthly payment. That's going to obviously hit the budget, but it's also going to impact your price point that you can qualify for. If your payment is $400 higher, well, now you're running into a problem because now you have to cut down the price of that property. You also want to consider from the sales side, you're buying a home. It's a competitive market. A lot of places out there, sellers are going to be holding all the cards, so to speak. When you're making an offer on that property, we want your offer to be as strong as possible. When we use FHA financing, the seller may look at that and say, I don't know, I'd rather go with this conventional loan.
No. No.
I don't make those rules. That's just the general consensus that's out there. Keep in mind, at the time of recording this video, it's a really competitive market in most of the country. This means that the seller is going to be the one who's picking their buyer, if you will. And they're looking for security. They want to make sure that if they accept your offer, this is going to make it to the closing table. It's not always about the highest offer, but it's about the one that they know will actually close. No one wants to go under contract to sell their home only to find out 2 days before closing they can't qualify. I'm not saying that's what happens with an FHA loan, but I am saying that there is this attitude from sellers that an FHA loan may not be the best option for them. So to change that impact and to take control of the situation, let's talk about what can you do to improve your credit score to make sure that when you're making an offer, you're in the best position possible. All right, before I go through these steps, I know some of this might sound obvious. Stick with it. You might find some things that are surprising you later on. Okay, jumping in with number one, pay your bills on time. I know that seems obvious, but you want to keep in mind that your credit score is a reflection of your ability to borrow money and pay it back. When you pay your bills late, now that's going to have an impact and lower your credit score. In fact, 35% of that credit score is made up on your ability to pay on time. So you don't want to pay late. Having one late payment can drop your credit score anywhere from 60 to 100 points. So you're in a position where this can have a much larger impact than you may be aware of. Quick tip and an easy way to fix this: set up auto pay on these accounts. This way you never have to worry about there being a late payment. And don't get cute and try to set it up the day that they're due. Always make sure you put a buffer in maybe 3 days before that due date, because you don't want to get caught with that due date falling on a holiday weekend and now your payment's late. When it comes to paying your bills and paying them on time, that's great, but you also want to keep in mind how much you're borrowing. We call this credit utilization. So you're going to hear this term when you're talking to creditors and lenders. Basically, we want to make sure that you're not maxed out all the time. If you're overextended on your credit cards, you go over that maximum limit, that's going to have a negative impact on your credit score. Again, credit scores aren't living and breathing. It's not personal. This is a math problem that reflects your ability to borrow money and pay it back. If you borrow more than someone technically was willing to lend you, well, now you're going to lose points for that. The sweet spot for creditors is to try and make sure you never exceed 30% of that utilization. I know what you're thinking. I travel for business. I use my card all the time, but I pay it off every month. That's fine. Here's a bonus tip. When you pay your card in that due date, they're not necessarily going to be in line with when the creditor reports to the credit agencies. So what do I mean by this? Let's say you have a card that's due on the 15th of the month. However, that creditor reports to the credit agencies on the 10th of every month. So great, you pay on the 12th because you're listening to me and you did it 3 days before the due date, right? So now we're in a position where you pay it and you're paying it on time. Well, the problem is that when they report on the 10th, they're reporting this high balance, which shows that you're maxed out on your card. You've got to watch out for that, because I've seen people who pay their cards off monthly who still don't have a credit score as high as they should because they're not following the proper strategies. All right, for the next strategy, this is going to depend on your timeline. So if you've got time, great. This may seem confusing, but the idea is if you open a lot of credit, that can hurt your credit score. If you're looking to buy a home in the next year, you shouldn't be opening a bunch of accounts, because all the inquiries that go into opening that account, as well as just the new credit itself, can actually drop your credit score temporarily. On the flip side, if you're opening new accounts, showing positive payment history, and you can let that season for a year or more, this is a great way to boost your credit score. It also creates a stronger credit score, if you will. And what I mean by this, let's say you have 5 accounts and they're open. One of those accounts has a late payment, unfortunately. Maybe it's something you just couldn't avoid and it happened, right? Well, you've got these other 4 accounts to offset that. You're getting positive payment history from those other 4 accounts. Flip the script. Let's say you only have 1 account open, and unfortunately there was a late payment. Big hit. That's where you're going to see that huge drop in your credit score, because you don't have the strength in your credit and your credit history. So keep in mind the timing of what you're looking at to do. If you have the time to open multiple accounts, manage them properly, this can be a great way to improve your credit score. All right, next in line is you want to dispute the errors in your credit report. So I think this goes without saying. You need to make sure that you're looking at your credit. Go through the free services that are out there. You can go through and you can access your credit, and you want to look at those accounts and make sure there's no surprise collections that pop up out of nowhere. But what if this does happen? What if something comes up and there's an error? You need to make sure that you're going through and taking the steps to have that removed. Don't save this for a rainy day. And fun fact, 1 in 5 people actually have errors on their credit. They may not even be aware of it. So this could be a simple mistake. Maybe something didn't happen and the payment didn't get made. If you make the call and you take the effort, there's a good chance you might have that removed, especially with credit cards. If you have a late payment on a credit card, it's the first time you were ever late, make that call to see if they'll remove that from your credit and show that this was a mistake. Most of the time you can get to the creditor before they report it to the credit agency. So if you have a late payment, you know you were late, it's been a few weeks, call, reach out. This can make a huge difference. Avoiding that late payment, again, can save you 20, 30, 50 points on your credit score. So you know the importance of your credit score, and we know ways that we can boost that. But what if you're in a position where you do have a lower credit score? Maybe you have a 550 credit score, you're looking to buy a home sometime in the next year. The good news is that you have some time to make these changes. First thing to look at will be your credit card balances. And set a plan. If you have higher credit card balances, I get it. It's not easy just to go and pay those down, but come up with a strategy that allows you to aggressively pay down certain accounts. Bonus tip on this, they're viewed equally, so start with the smaller accounts first. A $1,000 account that has a $500 balance is exactly the same as a $10,000 account that has a $5,000 balance. So make your money go further by paying down more accounts. The more accounts you keep with lower balances, the boost on your credit score. Now, how do I get my credit score? There's a lot of free services out there that you can go through. You can go through a lender that you're talking about, being proactive, and they can provide you your credit. But the one thing you want to make sure, you don't want a lot of credit inquiries. Over the next year, you need to avoid having hard pulls on your credit. Quick tip with mortgage lenders, we'll pull your credit for free, and we use a soft pull. So we can start a plan towards buying a home while helping you improve your credit. So you want to reach out to a professional and talk to them, get them on your side so they can help you make this plan. Another tip when it comes to your credit is obviously going to be those collections. So if you have collections open, talk to a professional. A lot of people don't realize that paying off really old collections can actually lower your credit score. It's kind of like opening an old wound. You may have had a scab that's turned to a scar. Well, if you go and you pick at that scar, then now what happens, right? You've agitated it. That's how old collections can work. If you haven't paid that account and it's not impacting your credit score, you don't want to necessarily shake the beehive. So talk to a professional, whether it's a mortgage lender or a credit counselor. There's some good services out there, and we can provide you notes in the liner about that. Buying a house is stressful enough. You don't need money stress adding to this. If you're interested and you'd like a consultation for free, I'm happy to talk to you. Feel free to reach out. We'd love to go over and see, is your credit where it needs to be? How does this look along with your income? How does that look with your savings? And overall, making a plan so we know how to make sure that you're in the best position when you want to look to buy a home.